Hey, what's going on, guys? Joseph here. Welcome to my channel where we help you get smart with your money. Look, to be honest, I don't see a lot of people who look like me on YouTube talking about finances, personal finance, talking about stocks. And I think it's so vitally important for people who look like me and anybody else who's watching this that doesn't look like me to be able to get a handle on their personal finances, because that can empower you to become who you want to be, to become the person that your family wants you to be, to become the person you think you should be for your family. And it just allows so much freedom if you start understanding that money is a tool and how to use that money. So a little bit about me before we jump into actually investing for beginners. I'm a former school teacher with a master's in education. I am a husband with 2 children, beautiful young boys. I also run a multiple six-figure business. And the idea here is to make sure that you understand why I'm doing this is because I started from zero, meaning I started off in a 1-bedroom house whenever I was a kid to where we are now, living in Singapore and being able to get ready to travel the world. And I want you to have those opportunities as well. I want you to be able to see what those opportunities look like so that you can take advantage of them whenever they are presented to you. So I'm really excited about this video because I put a lot of time into it. I put a lot of time into learning YouTube, into understanding investing, and obviously putting our money into investments. To be honest with you, I'm probably going to fumble a lot, and that's what this is all about. Me fumbling to learn how to get my point across to you so that you can start becoming a beginning investor or get better with your investments so that you can start planning for your future and have more freedom with more options. Another thing, don't be afraid to start off with making some small mistakes. That's kind of part of the journey, and we're all going to make mistakes. Just correct them as you go. Okay, now you know a little bit about me. Let's go ahead and jump in so you can learn how to start investing. So what I've done is I've gone out and purchased some courses on personal finance. We've actually invested coming up on $100,000, or some people call it 6 figures. I also reached out to some other experts to ask them questions on what the best basics are to get people started, compiled all that information, and that's what I'm going to be giving to you today so that you can get an idea and get a jump start and not have to go ask all these questions and buy all these courses. You just get the information and you can actually start implementing as soon as possible. I also want to say it's a fun process. Like when you start looking at what you can accomplish once you start learning about money, I just feel like it's a really fun journey. And those of you who are watching this are going to go on this journey with me to be able to see where you're going to be in 6 months, in a year, 10 years from now, because I'll probably still be doing this because I enjoy making content. I want you to see that it can really be fun. And, you got a lot of YouTubers that are out there that, they talk about finances, but they make it very, very tight. And I started off that way. I just want to be me. And I want you just to understand what you can accomplish and actually enjoy accomplishing it by seeing your investment account or your portfolio, which we'll talk about later, continue to increase over time and know what that's going to bring you in the long run. So my goal with this video and all my future videos is to hopefully give you that sense of investing can be fun and rewarding at the same time. And let's be honest, who doesn't want to wake up one day and say, if I did nothing else for the rest of my life, by the time I'm 65 or whenever you retire, you'll be a millionaire. And that's what I want you to be able to understand. As you take the right steps and you follow some of the steps we're going to talk about in here. And I'm not a professional investor. I just learned from other people and they've done the right things over time. And now I want to be able to give you that information that they've given me as a form of entertainment. That's the idea behind this. Be able to wake up one day and say, if I did nothing else, I would be a millionaire. So if you're watching this video and you have little to no knowledge about investing and you want to learn more and learn how to invest your money, then you've come to the right place. This video is specifically for you. And by the way, for those of you who want to learn more and dive a little bit deeper, I'm going to put some resources down in the description down below so that you can click on those and go learn more. I highly suggest that you do that because the more knowledge you get, again, the further you're going to be ahead of everybody else that you may be hanging out with. And not only that, the further you're going to be able to bring other people with you, because let's be honest, if you can retire a millionaire, you want other people to be able to retire a millionaire too, because you don't want to go on all these fun trips and do all these fun things by yourself. So the first thing we're going to do is I'm going to go through some terms because I feel like a lot of the terms are going to be new for most of you who are watching this. They were new to me, obviously, whenever I first started investing and my wife and I started investing. So I want you to be able to understand what these terms are. So if you go look at these other resources, you know what they mean. And then you can say, okay, yeah, I know what this person's talking about. And then you can take the information and do what you will with it, but now you'll at least know exactly what that term might mean. And then what we're going to do is we're going to go through different steps, as well as some great ways to start investing your money today. And be sure to stick around because later in the video, I'll be talking about different stocks that you can actually take a look into to decide if they're good for your portfolio that you're going to be building. So before you start investing, the thing you should do is actually take a good look at your finances. And I highly recommend that you follow these steps that I'm about to talk about. The first thing that you want to consider doing is having an emergency fund. So I talk about this on my Instagram quite often, that you need to make sure that you have an emergency fund. Also, other gurus like Dave Ramsey will tell you that this is a good strategy to follow to build up this little nest egg, if you will, to protect yourself. And another thing, it's just a great rule to follow because 2020 was a great example. A lot of people lost their jobs and a lot of those folks didn't have their emergency fund. And I'm sure if they had an emergency fund, they would have felt a lot more comfortable comfortable knowing that it's going to take 3 to 6 months to maybe find a new job. As we look at 2020 as an example, I hope you start taking this a little more seriously so that you can have this money available for yourself and your family if something were to happen. And again, anything can happen. When it comes to emergency fund, it's a good rule of thumb to start off with 1 month of expenses in your savings account, and then from there build to 3 to 6 months total of emergency fund, meaning that all your expenses would be covered with this emergency fund that's sitting in your savings for eating, living, paying for your mortgage, paying for your rent, paying for your car, whatever you have. But if you don't have that immediately, start off with trying to build 1 month of expenses, and again, build up to 3 to 6 months. So the second step is to pay off any consumer debt you have. It is so vitally important to pay off any consumer debt you have, because that's going to set you back years and years of building your financial plan and being financially free. So the main reason you want to pay off your consumer debt as quickly as possible is because your consumer debt typically has a higher interest rate than your investment rate will. So the longer you wait to pay off your consumer debt, the further behind you get in allowing your investments to grow to pay for your future. So let's give a real life example. You have a credit card that you're paying the minimum on and your interest rate is 20%. You have investments that are earning, let's say, roughly 8%. Well, you're flushing 12% of gains or of your money down the drain. So the money that you're making with your investments is completely being washed away by your consumer debt. It doesn't make sense to carry that 20% consumer debt and also invest at the same time. I'm not saying you can't do it. I know there are people that will, but I'm saying make sure if you can get rid of that consumer debt, your money will grow much faster. I also want to say, I know this is a very basic example of, consumer debt versus investing, but I want to make sure that we drove home the idea that, hey, don't flush any money down the toilet, get your money, take care of it, and grow your money versus paying a credit card company, allow them to grow their money. Now, the third step in this process is opening a retirement account or an investing account. So what's going to happen is I'm going to create an entire video that gives you a step-by-step walkthrough on setting up your own investment brokerage like a Vanguard or something like that. So be sure to subscribe so that you have access to that video, or you're ready to see that video when the time comes. So what you need to know is there are several different types of retirement accounts, such as Roth IRAs, 401ks, and your traditional IRAs. So let's talk about 401ks first. So a 401k is typically set up by your employer. So if you work a 9 to 5 or you work for some large company, what they'll typically do is if you have certain benefits, oftentimes they'll also offer a 401k. So the best analogy I can come up with as you look at a 401k is to say, my 401k is like a wallet that holds my stocks or my bonds or any type of investments that I'm making. And so my wallet is holding these things in my retirement account so that they can grow over time. So many of you may not even know you have a 401k or 401k option. You've sat in these boring meetings, you check the yes box. Well, guess what? You're investing. You just didn't know you were investing. So for those of you who did check the yes box, or for those of you who are considering checking the yes box later down the road in your company, let's dive a little bit deeper so you know what you're investing in and how this 401k works. So a 401k is a tax advantage retirement account. And what typically happens is you put in a certain amount of money, and whenever you put that money in, your company will typically match it up to a certain amount. And that certain amount that you put in there, we'll just call it's doubling because your company has matched it. Technically like free money that your company is giving you to grow your investment retirement account. So through this 401k, you're automatically being invested in stocks, bonds, and mutual funds. And don't worry if you don't know what that is yet, we'll dive a little bit deeper later on in the video. So next up we have your Roth IRA, which is another retirement account that allows you to put your investments in and allow your money to grow tax-free. So let's break down these investing terms a little bit more. So if you're unfamiliar with stocks, bonds, or just heck, the stock market in general, let's make sure you know what that means. So my goal here in this section is to make sure I make it as simple as possible for you to understand, because it can be very complicated. At least for my small brain, it was very complicated. So I hope that we make this as simplified as possible so you can start getting ready to start investing. The way I want you to think about stocks, it's a small investment to get a share of a larger company that you believe in that's going to help you grow your money. So the best example I can think of as a stock, I think most of you will probably know what this stock is, at least if you live in the US and probably most places now, is Amazon. With Amazon, you can buy a single stock of Amazon, which is just like a tiny itty bitty sliver of this massive company. And now you own a small share or part of the company. So next up, let's talk about the stock market. So a lot of you may have heard of the stock market. You may have heard your friends talk about the stock market. Oh, the stock market's up, the stock market's down. Essentially what the stock market is where places or companies like Amazon and Facebook and all these large companies that you can invest in and get a share of are held to let you see the shares of these companies, how they're performing, who the ownership is, and what's generally going on with this company, aka the stock. So an interesting thing to think about whenever you're thinking about the stock market is it's generally controlled by the emotions of the investors, that being yourself, myself, anybody who's investing. So let me give you a very real example. So in 2020, whenever everything started happening, investors got really scared. Their emotions started driving them to want to pull their money out to protect their money. And what that did was we had enough people who were so scared pulling out their money that the the stock market actually started to go down. So then later on in 2020, when things started to kind of normalize and these people who took their money out said, you know what, I think things are going back to normal. I'm going to start putting my money back into the stock market. Well, then the stock market started to trend back up. So that's what I mean whenever I say the stock market is typically controlled by investors' emotions. Whenever things seem bad, the stock market kind of goes down, and when things seem good, the stock market typically seems to go up. So let me tell you a little secret. The stock market, if you're invested in the right things, typically goes up and to the right. That means time is to the right, and up means positive. So don't be an emotional investor. So one thing you hear on the news and hear different investors talk about is risk versus reward. So sometimes what we'll see is the higher the risk, the higher the reward, and the lower the risk, the lower the reward. That's in the short term. I want to make sure I make that very clear. Now I'll make another longer video on what happens in the long term. I'll give you a hint. The boring investments usually take longer, but do really well in the long term. So I want to jump into one of the lower risk investments that investors typically talk about that you can take a look at as well. So let's talk about bonds. A bond is whenever you loan money to a company or the government for a fixed rate of return to be able to get your money back from that particular company or from the government. So your investment return is usually fixed, and so it's very predictable, and you know what you're going to be getting over a certain amount of time, which makes it more of a low risk investment. Next up, let's talk about investment funds. So an investment fund is basically whenever a group of investors take their money and they go invest in stocks, bonds, and other investments. However, one thing to note is you still keep your own shares if you're investing in an investment fund. So as it grows, your particular portion of investment is also growing with that particular fund. If you like ice cream, here's one way to think about an investment fund. So if buying a single stock is like buying one ice cream cone with one scoop, well, buying an investment fund is like buying a tub of ice cream with thousands or hundreds of different flavors. So now that you know what an investment fund is, and hopefully you like ice cream, let's move into understanding that there's several types of investment funds, but the ones I want you to focus on today are index funds and mutual funds. So a mutual fund is the OG of the group. They were the first to come around. They were created to allow people to invest their money into this large portion of different stocks, bonds, and different investments. One thing to know is that mutual funds are managed by a professional investment fund manager. So yeah, there's this very smart man or woman that's in the back pulling the strings, deciding what stocks, what bonds, what different investments that this particular mutual fund should be investing in. So what you're hoping for is that this person knows exactly what they're doing, using their big brain to be able to pick the right investments to watch your money grow whenever they're picking these particular stocks that they think are going to be very beneficial to you. So basically with one single purchase of mutual fund, you're able to buy hundreds, if not thousands, of tiny little pieces of shares of a particular company, which then gives you what we call diversification. And this can be important for a new investor rather than putting all your money in, say, like Amazon, which we were talking about earlier, and then Amazon's price just crashes and all your money is in that one basket. Well, with diversification and buying a mutual fund, if that stock crashes, you have hundreds, if not thousands, like we talked about, of other stocks that will keep your investment afloat. So this is why you may have heard or hear, or maybe will hear in the future, it's very important to diversify your portfolio. So basically, as your mom, grandma, grandpa, or dad have probably said, don't put all your eggs in one basket. A mutual fund allows you to not put all your eggs in one basket. Now, do keep in mind, we talked about this earlier, there is a smart person in the back end that should know what they're doing, that is pulling the strings and deciding what to invest in. And you have to be able to pay that person. You're typically paying 1 to 2% of your overall investment every year to this mutual fund manager. So for those of you who aren't interested in paying hundreds of thousands of dollars over the course of your investing career to a mutual fund manager, this is where index funds come in. I'm a huge fan of index fund investing and investing for the long term. Not only myself, this guy named Warren Buffett, who you may or may not know, you should know, he's one of the wealthiest investors ever, also believes in index fund investing. So an index fund is very similar to a mutual fund in that you're buying this bulk of stocks with one single purchase, and you're getting hundreds, if not thousands, of tiny little pieces of these companies that are held within this particular index fund. An index fund typically tracks or mirrors a certain part or all of the stock market. The key difference between an index fund and a mutual fund is an index fund typically has lower fees rather than being 1 to 2%. Some of the index funds will actually start off around 0.03%. A index fund doesn't have somebody in the back end pulling strings saying what investments that fund should be investing in. Rather, it's more of a passive investment. So now you're probably asking, well, how does it work if there's not somebody actually telling the fund what to invest in? So an index fund is really interesting because it's passively managed by a formula. And that formula basically says, hey, whatever the stock market is doing or whatever index it's tracking, make sure you're doing the same thing or as close as possible to doing the same thing that that part of the market is doing. So an index fund is usually something that you invest in for the long run, meaning that you're not going to take out your investments to have gray hair or you reach FIRE, which, by the way, if you don't know what FIRE is, financially independent, retire early, which I'm going to create an entire different video on so that you understand how people are doing this. But yeah, make sure you like and subscribe so that you can catch that video whenever I make that video for you. So how does this long-term investing work? Basically, the way your investment grows is through compound interest. And compound interest is just a fancy way of saying every time time your money starts to grow, the money that's being reinvested continues to compound on itself. So let's say, for example, you put $100 in, it grows at 10%. Well, then you have $110. That $110 is then grown at 10% more. So you keep stacking it over and over, and your money makes you more money. Another way I like to think about it is you've probably purchased something with a credit card in the past, and that money was a loan from the credit card company, and that money comes with a fee, right? So if you start thinking about that way, well, an index fund or a mutual fund is you're loaning money to your future self, and the more money that you loan to your future self, the more they owe you back in the future. So yeah, basically in this instance, you are the credit card company and you are the borrower. So you win in both instances because you're loaning money to yourself and your future self is paying you back more money. So yeah, at the end of the day, you're basically going to make your current self and your future self, who are the same people, filthy rich if you do it the right way. Okay, for you visual learners, let's go to investor.gov so you can see how this compound interest stuff works by being able to see it in action. By the way, you can do this yourself by going in and plugging numbers that make the most sense for yourself. I put the link down in the description, so you just click on it and put the numbers in, again, that makes sense for you. Okay, so let's just say you put $1,000 in an index fund to jumpstart your investing journey. And then you start putting in $100 every month for 30 years. And what we'll do here is put in an estimated 8% interest rate. And now let's see what your future self could hypothetically have in your investment account. I think your future self might be pretty happy. You're going to have $146,000 by originally investing only $37,000. And all you did was invest $100 per month and let compound interest start doing its job. Now I want you to think, what if I continue to get promotions in my job, I start cutting my expenses and start investing in more money? Again, that's why I put the investment calculator down below so you can start plugging in your hypothetical situations that you can start using to really drive your interest and hopefully your passion for investing. Just a quick hint, this calculator is the thing that got my wife and I so passionate about investing and got me wanting to make sure that I shared what I know now with you. Another thing to know that you may hear from other investors is the sooner you start putting money in, the sooner your money can start compounding and paying your future self a nice fat bonus. So don't wait too long to start investing if this is really something that you're interested in, because the longer you wait, the less you make. The more you put in the beginning and do over time, the more money that you could possibly make in the future. Basically, to shorten that, start investing as soon as you can. Okay, now that you have the terms down, let's dive into some of the best ways that you can start investing. So as we discussed earlier, one great way to start investing is to use a retirement account. I would say maybe looking at your 401k as one of the first steps, because your employer will possibly match your investment, which means you're almost doubling whatever you're investing to a certain amount that your employer will match. One thing to note is that if you are using a Roth IRA, you do have a max that you can invest every year. And that max is $6,000 total for the year if you're below 50 and $7,000 per year if you're above 50. Now, $6,000 to $7,000 may seem like a lot of money for a lot of you who are watching this, maybe beginning investors just starting your journey, maybe you're just starting your job. So what I want you to really think about is just invest what you can. You don't have to reach the max. If you can, fantastic, but just start investing so you can get excited about and actually watch your money start growing without you doing anything except putting the money in. You're not doing any manual labor to make this grow, of course, your job or whatever you're doing, but whenever the money's in there, you get to just watch it start increasing over time. So the cool thing is once you get started, you're just going to want to continue to invest more, because now as you get this new job, this new career, this raise, that money that you're putting in, you could be at home having your coffee or doing whatever you do in the morning in your pajamas, and you're just getting to watch your money grow. Maybe you watch Netflix, I don't know, but whatever you're doing, your money that you have in there that you've earned from your job is now earning you more money without you actually having to be at your job, which is a really cool thing to see. So let's do a recap on what you should consider doing before you start investing. First things first, make sure that you do have an emergency fund that is at least 1 month of expenses, and then grow that to 3 to 6 months of expenses. Number 2, pay off any large consumer debt like credit cards. And number 3, just start investing, maybe with your retirement account if your company offers a 401k match. Okay, now let's talk about different ways to invest your money. So when it comes to investing, there can be several different approaches. It just depends on what you're trying to accomplish with your investment. So some people or investors will actually go the high risk, high reward route and do day trading. I'll just say this, the higher the potential short-term gain, the higher the risk as well. And then you'll have other people or other investors who prefer a lower risk, long-term investing strategy like investing in index funds. As you can tell, I'm very risk averse whenever it comes to managing my money because I like to keep it and I like to watch it grow. You do what you need to do, but I'm just letting you know there are different approaches to investing. So now that you know that I like index funds and Warren Buffett likes index funds, let's talk a little bit about what different index funds that are out there. So there are literally thousands of different index funds you can look at, but we're going to look at what the S&P 500 is and what the Dow Jones are. And then there are also also these international index funds we'll take a look at in a later video. So now let's jump in to see what the S&P 500 is, because I'm sure a lot of you have probably heard this term tossed around in different circles or different places that you've looked online, but we want to dive a little deeper so you understand what it is. So essentially the S&P 500 is an index that tracks the top 500 companies in the US stock market. Now, if you're watching this video from a different country, of course, the name of the S&P 500 will be something different for your country, but it'll still track whatever the index is saying it's tracking for your country. Now, when you start investing, you're going to see that the different indexes that track the S&P 500 will be different based on which app or brokerage that you're using. I would say app in today's terms, like Fidelity, Vanguard, Schwab. These are the different types of investing apps you can use to actually buy an index fund that tracks the S&P 500. So my wife and I actually use Vanguard. It was created by John Bogle, who created the idea of investing in index funds and ETFs. So it's the OG of the group. And although it's not the easiest app to use, it does have some of the cheapest fees in the industry. However, just because that's what we use to invest our money doesn't mean you can't use other apps like Fidelity, Charles Schwab, and M1 Finance. Again, do the research that will make sense for you and your money and what feels the best for you to use. I'll also create a video that goes a little bit more in depth in each of them. So then hopefully you have a little bit more information that you can actually hear versus just reading. So we like to keep our money. It's another reason we use Vanguard with those low expenses, because the more money that we can keep in the actual investment itself or the fund itself, the more compounding that happens on that lump sum of money, which means that we make more money in the long run. So I want to tell you a quick story about index funds and why they're so important. That guy, Warren Buffett, I'll put a picture somewhere around here that we talked about earlier. He put $1 million bet on index funds outperforming certain hedge funds in the long run. He put a 10-year limit on this particular bet, meaning, hey, here's $1 million. I'm going to put it in index funds. You hedge funds have your $1 million. Let's bet. Let's see who's going to win to see who performs the best. Now, 10 years is a nice subset of data to be able to see, okay, these guys or gals, whoever were the ones that were managing the fund, had enough time to make adjustments and try to beat the actual index. I'll let you guess who won. Yeah, the richest man in the world, or at one point was the richest man in the world, but is still one of the top 5 richest men in the world, won. Now, if you have all of these really smart, intelligent people that were trained, maybe went to school for this, on how to invest properly and what to look for to invest and grow your money faster than the market, couldn't beat the index fund. And I'm not saying that some of them probably didn't. The vast majority have not. I think this year so far, 80% have not outperformed the stock market. Then you as a regular investor, or myself as a regular investor, might be better off considering investing in something like an index fund and letting it grow long term rather than trying to beat the market. One thing I want to make sure is clear, the stock market is going to have ups and downs, or waves as they call them. I want to make it abundantly clear that what typically happens and has happened over history, and I'll try to put a chart somewhere here in just a minute, the stock market has always gone up in its total value and to the right over time. And so a lot of people who get into the stock market, again, will buy with emotion or sell with emotion. But if you're invested in an index fund that tracks the S&P 500 or the total stock market, and you look at the chart, keeping your money in long term is usually a good decision. Not pulling it out and not messing with it really will help you in the long run. I'll also say this, even those terrible red days that people talk about eventually turn green if your money stays in the market. Okay, so now I know you hope what index funds are, like the S&P 500 and the Dow Jones. They're not meant to try to beat the market, but actually try to mirror the market. They're meant to be long-term investments, not short-term investments. So with that being said, the goal of the index, if you're investing in an index fund like the S&P 500 or the Dow Jones, is to not just put a little bit of money here and there, but actually invest for the long term over decades so that you watch your money that you've put in compound and grow, so that your future self will be happy that you started investing whenever you did and continue to do so without touching the money that's in your investment portfolio. So you often hear the statement, I want to make sure it gets across to you whenever it's coming from me, is that the best time to invest was yesterday. Well, the next best time is today. The sooner you can start investing, the sooner your money will start compounding. You've probably heard me say that 10 times in this video, but I think it's important for you as a takeaway from this video. Again, the sooner you can get your money in, the more money your money makes. Again, the more money your money makes. As long as you invest consistently, month after month, year after year, don't touch it. For that fact, don't even look at it, and then just watch it grow. Some of you may have heard the term trying to time the market. Best thing I can say is I wouldn't consider doing it. Maybe do a little bit more research, but it's not usually the best thing to do whenever you're investing. At the end of the day, long-term investing is really about putting a little bit of money in, or as much money as you can each month, and just letting it grow. Okay, now let's jump into talking about stocks with the ability to have higher reward, but also looking at higher risk. Now, I'm sure most of you, if you're watching this video, have probably heard about people investing in something like Amazon or Facebook or one of these tech stocks at the right time and making a lot of money in 2020 when the market was down. However, investing in markets like 2020 are not typical, and those type of returns are not typical returns. Now, not saying that you can't get really good at it over time. It's going to take a lot of knowledge and experience that you gain by going through the ups and downs. So although investing in stocks is much more risky than investing in something like an index fund, well, there are the potentials for having great returns. But I really want to stress that it is much higher in risk. And so your knowledge base needs to be much greater. I know I said that already once, but I just want to drive that home because yes, most of the stocks will go up at a certain point, but then they also will come down. So you just have to understand and know what you're doing if you're not planning on investing in something like an index fund. So what does this all mean to you? Basically, if you stick with it and you continue to learn and you continue to invest, you will start seeing your money grow, but you have to really stick with it and continue investing over time. So again, I am a big fan of investing in something that tracks the total stock market and diversifies my investment so that I'm not putting all my eggs in one basket like a single stock. Now, of course, with everything in this video and any investments that you're planning on doing or thinking about doing, make sure you do your own due diligence. You want to make sure you know what you want to do and not some random YouTuber telling you what they think is a good idea. So I'm not a professional investor. I don't claim to be a professional investor. I make these videos for entertainment, also for my boys to be able to watch whenever they're older. I just happen to be a nerd who enjoys making YouTube videos, that loves data and money. So for those of you who are ready to get started in your investing journey, there are apps out there like M1 Finance who let you buy fractions of a share rather than a whole share that costs, hundreds of dollars or, several $1,000s. And this allows you to build your portfolio and your investments on your own budget. So there's a reason millions of people are using apps like M1 Finance and other apps. I left a link down in the description below. If you invest your first $100, you get $30 for free for just opening your account and putting $100 into it. So simply go down into the description and click on the URL, invest your first $100 and claim your $30 for free. Okay, so that was my basics to investing 101 for anybody who is looking to get started with your investing journey. If you have more personal finance questions that you'd like me to make a video about so you can get answers, please feel free to drop them down in the comments below and I'll create a video on that particular topic for you. So if you made it to this point and you enjoyed the video, please be sure to like and subscribe. And if you want to learn more about the differences between mutual funds, index funds, and ETFs, make sure you click the video that's right here. And as usual, thank you so much for watching. Happy investing, and let's keep getting smarter with your money.